Netwealth Investments Limited is licensed to provide general advice. Our podcasts are not tailored to any one financial situation and may contain views of our presenters which may not align with Netwealth. The guests, organisation and Netwealth have an arrangement for their financial products to be available for investment through Netwealth platforms, and Netwealth may receive fees from the guest. More information about Netwealth can be found on our website, including our financial services guide and disclosure documents. Please seek professional advice before acting.
Welcome to the Netwealth Portfolio Construction Podcast, brought to you by the Netwealth Investment Research Team. Join us as we speak with key wealth management professionals to uncover opportunities and challenges on a diverse range of topics.
The Australian dollar is always going to be a volatile one. Look, although we have a core view that Aussie US goes higher, I think the volatility is going to remain a key feature here, so I don't think it's going to be a straight line journey.
With your host, Paul O'Connor.
Welcome all to another instalment of the Netwealth Portfolio Construction Podcast series. For those listeners that are new to the podcast series, I'm Paul O'Connor, and my role at Netwealth is as Head of Investments, which includes responsibility for the funds available on our investment menu and the products we issue as a responsible entity. The aim of the podcast is to provide listeners with insights into portfolio construction and strategies that may be appropriate to your clients' portfolios. On today's podcast, we have Thomas Averill, or Tom, the Managing Director and Portfolio Manager from Rochford Capital, and we'll discuss Australian dollar hedging, options to hedge Australian dollar exposure in portfolios, and Rochford's solution. Rochford provide treasury and market risk solutions to large or listed companies and institutional clients by advising in managing foreign exchange, interest rate and commodity risks, and on average advise on circa $20 billion in gross over-the-market transactions for its clients annually. Rochford works with a broad cross-section of corporates and has many years of extensive experience in structuring and negotiating hedging solutions with financial institutions. Hence, they're considered highly experienced in currency overlay solutions and foreign exchange advisory services. Tom is an economist by degree with numerous qualifications in foreign exchange, treasury and derivatives. Before co-founding Rochford, Tom spent 8 years at HIFX, originally in the UK, before arriving in Sydney in early 2007 to launch HIFX's FX advisory business to the Australian marketplace. Tom has extensive experience advising some of the largest companies in Europe and Australasia on treasury risk management. The Netwealth IDPS investment menu includes the Rochford Leveraged Long Australian Dollar Fund, which is currently only available to wholesale investors and some managed accounts. The investment objective of the fund is to provide investors with a geared exposure to a depreciation in the US dollar relative to the Australian dollar. The fund seeks to provide investors with up to 3 times leveraged capital return on the performance of the AUD-USD exchange rate. The Rochford Leveraged Long AUD Fund seeks to provide a low-cost entry point to a beta exposure to the AUD-USD exchange rate on a daily basis and hence is not actively managed. So essentially it's trying to provide a reliable hedging solution rather than attempting to generate any alpha out of currency trading. Given the increasing sophistication of clients managing diversified portfolios using Netwealth's platform functionality, the Rochford Fund stands out as a possible currency hedging solution for those wishing to hedge all or part of their US dollar portfolio exposure. Finding solutions to hedge US dollar exposure can be a challenge given most diversified portfolios will typically have a strategic allocation to AUD hedged and unhedged offshore assets, and over 50% of the offshore assets are typically US domiciled. This is where an allocation to the Rochford Fund could assist in managing the currency exposure as opposed to buying and selling units in a hedged and unhedged international equities fund. From a portfolio management perspective, the AUD is one of the most volatile currencies globally due to it being viewed by many as a proxy for global growth. What I mean by this is when global growth is strong, the demand for Australian commodities places upward pressure on AUD pricing and vice versa. The outcome from this is that in the last 15 years, the AUD has traded between about US 50 cents and US $1.10. So this volatility can materially impact on a portfolio's return. In addition, with the AUD-USD currently at about 64 cents, this would be viewed by many as at the lower end of the trading range, and is when some diversified portfolios would consider increasing their AUD hedge exposure. Economists have long debated the true value of the Aussie compared to the US dollar, but using academic measures such as purchasing power parity or interest rate parity, many view the AUD-USD fair value at around 75 cents. Of course, projecting currency values accurately is close to impossible, which is why many diversified portfolios set a strategic currency hedge exposure over their portfolios and don't attempt to actively manage. But I'll be interested in hearing Tom's views on the challenges of active currency management. Maybe, Tom, for starters, can you provide a few comments on your career journey and how you ended up specialising in treasury and managing market risk and even founding Rochford?
Yeah, absolutely. And Pog, thank you for that kind introduction and the opportunity to be here today. Yeah, career highlights so far. I actually started in investment banking and corporate finance after qualifying as an economist. To be honest, although that was good fun, I enjoyed it. It was too micro for me. And there was a requirement to be an accountant, which didn't really kind of float my boat, and wanted to get back into the macro space, which ended up me in FX, which is FX interest rate markets being the kind of best markets to apply for like economic views or macro ideals on things. HRFX transferred me to Australia in 2007 to launch their advisory business here. HRFX, which is now known as XE, incidentally, which is probably a more recognizable brand to your listeners rather. HRFX bought XE with a focus really to become more of a retail-focused payments business. And my ambition for the advisory business was to become top-end of town, institutional, looking after asset managers, private equity, big corporates. So there was kind of a divergence in views on the direction of travel there, which resulted in us doing the MBO in 2010 and forming Rochford, and that becoming not just a currency business, but broad macro risks and treasury issues. As you said, we look over after 20 billion across Australian corporates, but also a lot of asset managers, including PE, real estate, equities, all different types of asset classes. So we're kind of well positioned to understand how currency risk plays in overall portfolio returns and risk diversification, all the other things that are important in the way you construct your portfolios. One thing, what was interesting from your introduction there, talking about $1.10, just considering the news flow that we've had through the weekend. I don't know if you recall what the news flow was when the US hit $1.10, but it was the last time that the US had a credit downgrade. And given that Moody's has dropped its AAA rating through the weekend, I think that's kind of a topical point to highlight.
I remember it well, sort of post the GFC when the Aussie hit about $1.10, and the buying opportunity in offshore goods was a great time for Australian consumers there, including myself. But we're a little bit more moderated now at 64 cents there.
Well, so, absolutely. Yeah. I was giving a presentation to a group of treasurers last week, and I said, look, the de-dollarization of the global economy is a real thing, and US credit risk is a real thing, but it's going to take some time. But I think you can tell your kids that you can take them to Disneyland in 2027 because, I think you're going to see a material weakness in the dollar from here.
In terms of questions for today, first one, can you provide a few comments on how you see institutional investors managing currency risk in their portfolios?
Yeah, absolutely. I think the biggest and most stark thing to draw your listeners to is actually how currency risk is managed depending on the underlying asset class and expected volatility and return profile that you're looking to manage the risk on. So, for example, if you've got an income asset that's not going to provide a huge amount of capital return, typically you're going to see institutional investors carrying a high degree of hedging against those type of investments, so fixed income, private credit, because currency risk can completely wipe out the income and have obviously a detrimental impact on capital. When you're looking at more absolute return type investments, then they're going to have a lower degree of hedging. And that's really kind of a vol thing. If you're looking at kind of venture capital, which is just going to be looking to drive big outcomes, then currency risk is going to have a smaller delta on overall returns. So if on the capital side, the things where you're looking to slow and steady wins the race type allocations, then currency risk can be more destructive to returns. And then, interestingly, with the Aussie dollar, its correlation with underlying equity markets, for example, fluctuates. But when you're looking in low yielding environments, so when you see like straight out of COVID, straight out of the GFC, the Aussie dollar's correlation to equity markets becomes pretty strong. So we saw in post the GFC, for example, the S&P rallied by like 90%, but Aussie went from 60 cents to $1.10. So if you just had an S&P index fund post the GFC, you only sort of nominally participated at 14% of the 90% rally. Its impact on returns depends on asset classes and can vary over time.
Given where the AUD dollar value is at against the US dollar currently, do you view this as low compared to true value, whatever that true value is, as I sort of mentioned in my opening comments?
Yes, I do. And yes, we do as a firm. You rightly mentioned sort of the long-term ranges of Aussie US. But those kind of, the real kind of, if you like, non-black swan floor is typically around 65 cents, right? It spent very little time below 65 cents. You obviously saw the GFC send it to 60, COVID sent it to 55, and then the sort of Fed sent it into the low 60s, and then Trump sent it to 59. Outside of those kind of big macro shocks, and you've seen the Aussie obviously bounce relatively aggressively off the 59 as Trump has kind of walked back his tariff aggression. So yes, we do view Aussie down here as long-term value. As you point out, it's probably about 14 or 15% undervalued from a PPP standpoint. The dollar is also significantly overvalued. So when you look at the dollar potentially losing yield support or losing some of its yield support against a big deficit and Trump pushing back from a global agenda, all of those things we think. So it's not just a sort of an Aussie dollar story, but concerns about the strength of the greenback over the longer term.
Whilst we're seeing some moderation in the Trump's administration use of tariffs, what impact have the increased US tariffs had on the AUD, and what do you think will be Trump's longer-term impact on the USD? So
the sort of immediate aftermath was this kind of drop down in Aussie US down to 59 cents as Trump really rallied risk markets across the world, and Australia's reliance on Chinese trade being a kind of driving force of that initial market reaction. But then the kind of lens has shifted more from, and they've got these two competing forces. One is the impact on global trade and China in particular, and the impact on the Aussie dollar. And then the other one is how much actual destruction is Trump going to do to the US domestic economy, not just from tariffs, but also he's talking about trying to remove $2 trillion worth of public spending, which is about over 6% of US GDP. I think if you get the market more concerned about US domestic economic destruction and that playing out in greater curve inversion for the US interest rates, then I think that's pretty Aussie-US supportive. Largely most of his tariffs haven't really been followed through on, and I think that's typical of Trump's negotiating style, that he goes incredibly aggressive, knowing he's going to have to walk back from there. I also think he's been quite surprised at how the market's taken it. So I expect Trump to continue to moderate his position and Aussie-US to be reasonably well supported as a consequence of that. But longer term, I don't think his policies are going to be, short of his sort of bureaucracy ones, be that good for the US economy. I think he's really done some hammer blows to overall confidence. And despite the fact that he's walking back, lots of the damage has been done in terms of international relations. American reliance is no longer there. So I think you are going to see lots more trade agreements and bilateral stuff done exclusive of the US. So I do see the sort of US exceptionalism and US reliance diminishing over the longer term, and that which also is going to impact appetite for US debt, which is way worse than it was in 2010 when Aussie US was $1.10. So I'm a sort of long-term bear on the dollar.
Do you think Moody's downgrade of the US credit rating there, sort of Trump's tariffs and his first few months in power, have pushed them over the edge to make that decision? Or do you think it was inevitable with the, just that ongoing debt that's piling up in the US?
Yeah, arguably it was inevitable, really, because he's also, I think the bigger thing for them is he's got this proposed tax cut, which potentially makes the fiscal position of the country worse. And you've also got to remember that, Moody's is one of the few agencies that hadn't already downgraded the US. So I think it was just a matter of time before they just sort of joined. I think it was Fitch's who already did it, who were the ones that did it in 2010, 2011. I don't think it's particularly a kind of knee-jerk reaction to them. The US debt is, apart from Japan, which has a really great ability to sort of recycle debt with its own economy, is the biggest in the Western world by as a proportion of GDP by a long way. Where you compare that to Australia, that although domestic headlines might say that we're a bit skint, we have one of the best balance sheets in the OECD, which again leaves us relatively well placed to perform strongly.
China appears to be structurally slowing, and given they're Australia's largest trading partner, could this mean the Aussie dollar will remain lower for longer against the USD? And are there any other macroeconomic risks that you're seeing on the horizon?
I think the Australian dollar is always going to be a volatile one. And look, although we have a core view that Aussie US goes higher, I think the volatility is going to remain a key feature here. So I don't think it's going to be a straight line journey. With regards to China, there is obviously concerns about debt in the system and slowing growth, and particularly issues with real estate. The retreat of the US from the global economy to a certain extent, or America First policies, does create a vacuum for China to fill. And if you look at how China has grown to where they are now over the last 20, 30 years, they've kind of followed, which is ironic really, a post-Second World War American playbook where they were the biggest infrastructure investor globally, which allowed them to gain the sort of influence that the US has gotten to is now. But I think that void is going to be, or is already being filled by China, will continue to do so. So despite the sort of domestic slowdown concerns, I actually think that China is going to remain a big global investor, and Australia will benefit from that tailwind. So I think there's some short-term, medium-term potentially issues. But you got to remember, China is still like a billion plus people with a growing middle class. So I don't think the China story is over at all.
Yeah, it's interesting. I think we saw it in Trump's first term where the focus of the policies were far more internal and pulling back from globalisation and to a degree resetting their position for the role in the world. So for mine, I guess that could lead to longer term geopolitical risks. And as you say, China will step in to fill the void. We've seen Russia also trying to open up trading with certain countries there. So yeah, I think longer term it'll be interesting whether this internal focus of the US government lasts beyond Trump's current term. So
on that POC, I have a sort of key point. Even if he gets hammered in the midterms and loses to the Democrats in the next election, or the Republicans lose to the Democrats in the next election, and American people vote for something different, I think the rest of the world has gone, right, well, America has now elected this guy twice and has voted. So it's not just a Trump thing. The rest of the world now doesn't think they can trust the American public. So you're going to see Europe, like if you look at, and you've probably seen this from an asset allocation, European defence stock ETFs spring up all over the place, and defence. So everybody is now investing on the assumption that they can no longer rely on America, and you're going to see that in the way that you already are seeing it in the way governments are acting. Even if there is a reversion of course in the US political scene, I think wheels have been set in motion now that can't be turned around.
Imagine a world where wealth technology is simplified. With Australia's #1 platform for overall satisfaction and value, you don't need to imagine. Netwealth is continually investing in new tools and platform features to optimise your staff productivity and to give you and your clients the best user experience. With our managed accounts functionality, bring new efficiency and scale to your investment operations. A world of technology awaits. Discover it at netwealth.com.au/woo. Rated by Investment Trends #1 for overall satisfaction by users from 2014 to 2022.
Moving to Australia, have you got any thoughts on the impact of the Federal Labor's recent federal election win and whether this will be a positive for Aussie dollar growth and returns, obviously, in your fund?
I mean, it's an interesting one because I mentioned this in the presentation the other day, and it's probably the Australian election was one of the biggest non-events ever from a kind of markets perspective. They were both parties, if you look at those sort of economic policies, were campaigning on the same two key issues, being the cost of living and housing. So there wasn't a lot to set them apart on core key economic issues. Migration, for example, is a sort of hot topic for voters, but actually is not as influential from a sort of overall economic outlook standpoint. And Australia is, although it has its differences, isn't as kind of politically polarized as other parts of the world. I think generally markets preferring the sort of the known entity, the incumbents. So I would argue, potentially that the Labour Party and Albanese staying in should be relatively constructive for the Aussie dollar, but largely irrelevant.
Yeah, I hear you. It seems to become less and less relevant, our federal elections, when neither party want to stick their neck out for anything too structural in reform or anything that may risk losing seats in more marginal electorates. So
some of that, there's two sides to that. Some of that's frustrating that everyone's so worried about getting elected that nothing ever changes, and you've got very short terms in Australia. So I think that's the downside of it. But when you look at societies that are actually both parties of centre-right and centre-left, that's usually a sign of a relatively well-functioning society which doesn't have, for example, the levels of extremist wealth gap that you've got in the US and parts of Europe.
Yeah, very valid point. You've got to keep a healthy and large middle class, obviously. It should be one of the long-term aims of all the political parties. We've been sort of musing on all of the global issues going on. How does all of these risks we've been talking about impact on returns in the Rochford Fund?
As you pointed out, our fund provides a 3x exposure to the Aussie dollar versus the US dollar. So really, it's kind of anything that impacts the Aussie dollar impacts our fund by a magnitude of 3. And what we try and do, again, because of our sort of background in treasury, although we don't actively manage the currency exposure, we do actively manage the cash of the fund to make sure that the liquidity of the fund is maximized all the time. And then we invest that cash to then achieve total cost recovery to investors, to allow investors to have a kind of straight through participation. And where that's good is it means you can sort of accurately allocate. If you're trying to achieve a specific level of hedging within your portfolio, you can accurately allocate to our fund to do that. That would be the main driver.
I guess in simplistic terms, if we do see the AUD dollar appreciate against the US dollar, it's going to generate 3 times leveraged returns on that exposure within your fund.
Hugely, right? So let's say that we do get back to fair value. So we get back to 75. That's going to be a 50% plus return in our fund.
Quite a significant return that should obviously be thought about and how it will offset potential losses in equities due to the currency movement there. So it's about balancing, I guess, the thought of how this fund would be used in alignment with the rest of the offshore growth assets in a portfolio.
Yeah. And to go to your earlier point around how currency hedging plays into asset allocation, I think if you've got US dollar denominated assets in there that are kind of more income distributing assets or not high growth, they're the ones that you should be looking at from a hedging or de-risking from a currency standpoint. Also, if you've got US dollar denominated assets that you're not going to be holding there in for the long term, so medium term volatility is going to have an impact. But again, it's those kind of assets where currency hedging can be more important for overall returns.
You deal a lot with the investors that are using your fund, and what's the feedback in terms of how they're using the Rochford Fund and what they're trying to achieve, and how does that align with how you've envisaged the fund would be used?
I believe so. We have some SMA managers that use our funds and some other big wealth platforms that actually consider allocation to our fund, actually describe it in their tools as a hedge. Again, the sort of advantage, or one of the main advantages is of, the accuracy in which you can allocate to our fund. So if you want to say reduce your exposure to the US dollars in a particular asset by 50%, then a 16.66 allocation to our fund will achieve that. And as I say, we have a cash management strategy that helps the fund achieve cost neutral Also, because of the economics of scale that the Rochford relationship brings to the fund, given we do over 20 billion in derivatives, the underlying derivatives that we execute in the fund cost half a currency point, so the fifth decimal place. So we've really negotiated institutional grade execution within the counterparty relationships that the fund has.
I think it's an important point you touched on there, Tom, the sizing, the exposure. Could you maybe touch on that again? So if I wanted to hedge $100 exposure in my portfolio to USD, what sort of allocation would I be looking at in your fund?
So if you wanted to hedge 100% of that $100, then that would be $33.33 because it's exactly three times.
Which, yeah, correct, as you said, the leverage in the strategy there. I mean, I guess in the wealth management market, there has been really a lack of opportunity for individuals to take on, to hedge currency exposure and US dollar exposure in their portfolio. Obviously, Insto investors, the very largest investors in Australia, they have the resourcing and capability to be able to directly, I guess, engage a business like yours to assist. But are you aware of any other competitor peer strategies? And if you are, how do they actually differ to your product?
There is a sort of primary competitor to ours in Australia that has a listed ETF, but the way that they provide the leverage, and if you like, the quickest to market or the cheapest way to provide leverage in a currency fund is via futures. If you provide it via futures, it means you're subject to, one, I think futures are more expensive than OTC. And also you want to deal in lot sizes, so getting it absolutely accurate and the rebalancing is challenging. Also, you have to have cash at your futures broker for daily margining, right, with futures. Now, that is not the way, if you like, institutional overlay works. Within institutional overlay, you go and negotiate direct bilateral leverage facilities with investment banks, which means that you actually have your cash available to invest and get some sort of yield return in the fund. Because we had that institutional overlay experience and the relationships with those banks, that is how the Rochford Fund has achieved its leverage by what's known as ISDAs and CSA agreements with our investment banking counterparties, as opposed to just going straight off the market and giving futures, which, to be honest, doesn't really provide that much value to an individual investor, because an individual investor could trade futures themselves on one of those kind of the stock brokerage programs. So we've actually tried to put a wrapper around institutional grade solution and then access to wholesale investors via platforms such as Netwealth.
What type of return would you be getting on the cash collateral? As you point out, when you're actually implementing hedging using futures, the cash is stumped up with the exchange and you get a 0% return on that cash.
So at the moment, we're getting on our cash, we're getting roughly about RBA. We were doing a bit better. When the curve was not, interest rate curve was inverted, we were getting a bit better than that with term deposits. We have to be careful about how much we put on term, given that the fund is daily price and daily liquid. So we have to have liquidity available to our investors. There is also interest cost in the underlying derivative, which has been, and that's this idea of carry. Now, if you buy a higher yielding currency, you receive the carry. If you're selling a higher yielding currency, you have to pay the carry. Now, for the last, while the fund's been existing, we've actually been negative carry because US rates have been higher than in Australia. And that's been a big cost of the fund because that's multiplied by the leverage. If we're in a situation where US funds fall below that of Australia, US interest rates fall, then the fund not only earns the interest on its cash, but also earns carry. Now, that doesn't look like it's imminent, but I think that should happen within the next 6 to 9 months.
Well, I'd imagine structurally long-term, Australia's typically had higher rates than the US
it has.
To attract capital to our country. So I would have thought over the long term you could expect to also get some smaller return out of the carry component in your strategy.
We expect that to occur too. I think the Fed was a bit on the sidelines last time around, but we expect the sort of economic slowdown in the US to probably be a bit starker than the market is currently predicting, and the Fed to have to go a bit more aggressively than the market is currently predicting. But that's more likely to happen in the back end of this year than imminently. But I think Fed cutting, we talked about Aussie returning to 75. I think Fed cutting would be a prerequisite for that to happen.
Maybe finally, can you provide a bit of a summary on how your strategy actually implements the currency hedging in the fund? You've touched on, obviously, the use of over-the-counter derivatives, but yeah, I think that'd be of good value to the listener and certainly myself, educative.
Absolutely. So it's not hugely complicated in terms of that we execute basically forward and swap currency transactions. The swaps are just to manage the maturity profile, which we also try and manage to maximize the liquidity. But simply put, on a daily basis, we net settle the investments and redemptions, typically off a fix, to make sure all investors are treated equally and that we achieve best execution. As I mentioned earlier, we have fixed execution spreads from our counterparty, which is, well, it's basically $50 a million, so half a basis point on the fifth decimal place of Aussie-US exchange rate. So incredibly competitive execution, which your listeners wouldn't get access to if it wasn't sort of getting aggregated up through the relationships that we have.
No, well, Tom, it's been a really fascinating discussion with you today, something that I haven't spoken to a currency portfolio manager previously on the podcast series, so I know it's certainly been an educative session for myself, and I hope also for the listeners there too. So I thank you for joining us on the podcast today, and certainly wish you all the best with the fund. When I think I first met you maybe 18 months, 2 years ago, it certainly struck me as a product and an investment strategy that I'd like to understand a little deeper, because there's not a lot of competitors in this marketplace, and I do think that particularly in the growing area of managed accounts and the number of consultants running portfolios on our platform now, we're getting more sophisticated, I guess, insights, quasi-insto insights into managing portfolios. So I certainly think this could be an option for those wishing to hedge USD exposure in potentially a more efficient way than buying and selling out of a hedged and an unhedged fund there, Tom. So certainly wish you all the best with it.
Thank you very much, Paul. I mean, just actually on that last point there, you say, if you're switching between hedged and unhedged, obviously you're going to realize capital gains events, whereas with our fund that won't happen. So our fund does allow you to adjust your hedging ratios just by right-sizing your allocation to our fund rather than having to switch from one underlying hedge unit class to another.
Well, thanks again, Tom. Have a great afternoon. To the listener, thanks for joining us again on another instalment of the Portfolio Construction podcast series. I hope you've enjoyed the macro musings of the earlier discussion on today's podcast, and then also finishing with some direct insights into how the Rochford Fund works and how it's I guess, fairly unique at the moment in terms of products that I've seen available on our investment menu. So I'm hoping you have a great day and look forward to you joining us again on the next instalment of the podcast series.
Thanks for listening to Netwealth's Portfolio Construction Podcast. Follow the show for future episodes. Leaving a review helps others find the podcast. And for more information and show transcripts, visit netwealth.com.au.